In 1975, the median home price in America was $37,200. A factory worker earning $12,000 a year could walk into a real estate office on a Saturday morning and walk out a homeowner by lunch. One income, one job, 3 times their annual salary bought a house, a yard, and a foundation for building wealth. In 2026, that same house costs $428,000. A couple with 2 full-time jobs and a combined income of $95,000 can't afford it. They need 6 years of their combined salary just for the purchase price, and they're still renting. What happened? The economy didn't shrink. America got richer. We produce more than ever. So why did homeownership go from achievable to impossible for the middle class? The answer isn't what most people think, and the numbers tell a story that explains everything. To understand what changed, we need to establish what normal looked like in the 1970s. This was the American middle class at its peak. According to the US Census Bureau, the median home price in January 1975 was $37,200. Not adjusted for inflation, actual 1975 dollars. A 3-bedroom, 2-bathroom house with a yard and garage in a decent neighborhood. The median household income that same year was $11,800. In most families, only one person worked full-time. That single income supported a family of 4. Here's the critical ratio. $37,200 divided by $11,800 equals 3.15. A house cost 3.15 times the median household income. 3 years of salary could purchase a home. This is what economists call affordable housing. The monthly mortgage payment on a $37,200 house with a typical down payment was approximately $285. That represented 24% of gross monthly income. The cost of living supported this model. A week of groceries cost about $20. Gasoline was 57 cents per gallon. State university tuition was $617 per year. A doctor visit cost $10 without insurance. Property taxes averaged $400 annually. Employment came with benefits that are rare today. Approximately 35% of workers belonged to unions that negotiated for wages, benefits, and job security. Most full-time jobs included a pension, guaranteed income for life after 30 years of service. Savings accounts paid 5% interest. On a single middle-class income, families could afford annual vacations, Christmas presents, emergency savings, and still build equity in a home. This wasn't wealth. This was simply being middle-class in America. This was the deal. Work hard, play by the rules, and you could build a secure life. Fast forward to 2026. On the surface, America appears more prosperous than ever. But for the middle class, the economics have fundamentally changed. Consider a typical middle-class couple in 2026. Both work full-time in professional roles. Combined household income, $95,000 per year. That's significantly higher than the 1975 median of $11,800, even after adjusting for inflation. But here's what changed. According to Redfin, the median home price in December 2025 was $428,000. The new ratio, $428,000 divided by $95,000 equals 4.5. A house now costs 4.5 times the median household income. But remember, this is the combined income from 2 full-time jobs. In 1975, one income, 3.15 times salary buys a house. In 2026, 2 incomes, 4.5 times salary buys a house. With a 20% down payment of $85,600, the monthly mortgage payment at current interest rates would be $2,600. Add property taxes and insurance, and total housing costs reach $3,250 per month. That represents 41% of gross monthly income, compared to 24% in 1975. And the cost of everything else has increased. That $20 weekly grocery bill is now $285. Gasoline at 57 cents per gallon is now $3.89. The $10 doctor visit is now $285 with insurance. The $617 annual college tuition is now $28,000 per year. The structure of work has changed as well. Only 10% of workers now belong to unions, down from 35% in 1975. Pensions have been replaced with 401k retirement accounts where workers bear all investment risk. The 9-to-5 workday has expanded into evenings and weekends. 2 incomes, 2 college degrees, both working over 40 hours per week, and they're further from home ownership than a single-income factory worker with a high school diploma was in 1975. This isn't a story about people not working hard enough. This is a story about a system that fundamentally changed. Here's the paradox that requires explanation. The American economy didn't fail. By every measure of total economic output, the United States became dramatically wealthier between 1975 and 2026. Gross domestic product increased. Worker productivity soared. Corporate profits reached record levels. The economy created an enormous amount of new wealth. So if there's more money, where did it go? From 1950 to 1980, the Federal Reserve data shows something remarkable. As the economy grew, wages grew proportionally across all income levels. Low-income workers, middle-income workers, and high-income earners all saw their compensation increase at roughly the same rate. This is called shared prosperity. When the economic pie got bigger, everyone got a proportionally bigger slice. Then, around 1980, something changed. Watch what happens to these lines. The high-income line separates from the others and accelerates upward. The middle-income line flattens. The low-income line barely moves. The economy continued growing, but the distribution of that growth changed completely. Consider executive compensation. In 1965, the average CEO at a major US corporation earned approximately 21 times what the typical worker earned. By 1980, it had grown to 42 to 1. By 2000, it reached 120 to 1. As of 2024, CEOs at S&P 500 companies earn 285 times what their median employee earns. Before we continue, if you're finding this information valuable, please subscribe to this channel and leave a comment below. What surprises you most about these numbers? Are they different from what you expected? We'll explore 8 specific policy changes that caused this shift. But first, hit that subscribe button and let us know your thoughts in the comments. Now, let's talk about what specifically changed. The economic divergence didn't happen by accident. Between 1980 and 2026, 8 major policy changes fundamentally restructured how the American economy operates. These weren't natural market forces. These were deliberate political decisions. Policy change 1: massive tax cuts for high earners. In 1975, the top marginal tax rate was 70%. Beginning in the 1980s, that rate was slashed repeatedly to 37% today. The wealthy retained significantly more income. Government revenue for middle-class support programs declined proportionally. Policy change 2: systematic weakening of labor unions. In 1975, 35% of American workers belonged to unions. Starting in the 1980s, federal policy made union formation more difficult and union busting easier. Union membership declined to 10% by 2026. Without collective bargaining power, workers lost leverage in wage negotiations. Policy change 3: replacement of pensions with 401k plans. In 1975, most full-time workers earned a pension, guaranteed retirement income. In the 1980s, companies began replacing pensions with 401k plans, where workers must save independently and bear all market risk. This transferred trillions of dollars of risk from corporations to individual workers. Policy change 4: defunding of public higher education. In 1975, state governments funded approximately 75% of public college costs. Students paid 25%. Today, those numbers are reversed. This caused tuition to increase from $617 to $28,000 annually, a 45-fold increase. Policy change 5: healthcare industry consolidation. In 1975, a doctor visit cost $10. Healthcare consumed 7% of GDP. Deregulation allowed massive consolidation. That $10 doctor visit became $285. Healthcare now consumes 18% of GDP, the highest in the developed world. Policy change 6: financialization of housing. In 1975, most home purchases were made by families. Starting in the 1980s, housing became an investment asset class. Private equity firms, foreign investors, and corporations began purchasing homes. First-time homebuyers now compete against Wall Street firms with billions in capital. Policy Change 7. Shareholder Primacy Doctrine. In 1975, corporate leadership had responsibility to workers, customers, and communities. In the 1980s, the shareholder primacy doctrine became dominant. One mandate: maximize shareholder value. This meant cutting wages, eliminating benefits, and outsourcing jobs. Policy Change 8. Widespread industry deregulation. In 1975, federal regulations protected consumers and workers. Beginning in the 1980s, these protections were systematically removed. Financial deregulation contributed to the 2008 economic collapse. In nearly every case, deregulation increased corporate profits while reducing worker security. These 8 policy changes didn't occur in isolation. They were coordinated shifts that fundamentally restructured American capitalism from a system that broadly distributed prosperity to one that concentrates wealth at the top. Data and policy changes tell one story, but what does this mean for actual people trying to build lives in 2026? Consider a typical scenario. A couple, both age 30, both working full-time professional jobs, combined income of $95,000. They've been saving for a house down payment for 3 years. They've accumulated $42,000. They need $85,600 for a 20% down payment on a $428,000 house. Meanwhile, they're paying $2,400 monthly rent. Over 3 years, they've paid $86,400 to a landlord, more than the down payment they're attempting to save. This money builds equity for the property owner, not for them. The statistics reflect this widespread struggle. In 1980, 45% of Americans under age 35 owned homes. In 2026, that figure has fallen to 37%. Economists measure intergenerational mobility, the likelihood that children will earn more than their parents. In 1975, you had a 90% probability of out-earning your parents. Today, that probability has fallen to 50%. It's now a coin flip whether you'll achieve greater prosperity than the previous generation. Then, an unexpected expense occurs. A medical emergency or car repair. These routine disruptions delay their homeownership timeline by months or years. This creates a compounding effect. In the 1970s, middle-class homeownership built generational wealth. Homes purchased for $37,200 are now worth $428,000. Those who owned then have accumulated substantial equity. Those unable to buy now are locked out of wealth building through real estate appreciation. The gap isn't just about income anymore, it's about accumulated wealth passed between generations, and it's widening. Let's summarize what the data shows. In 1975, median home $37,200, median income $11,800, house-to-income ratio 3.15 times, housing cost 24% of income, CEO to worker pay 21:1, union membership 35%, college tuition $617 per year, single income supported a family. In 2026, median home $428,000, median income $78,000, house-to-income ratio 5.5 times, housing cost 41% of income, CEO to worker pay 285:1, union membership 10%, college tuition $28,000 per year. 2 incomes struggle to support a family. The economy grew, productivity increased, wealth was created, but the distribution mechanism changed. This wasn't inevitable. This was the result of specific policy decisions made over 45 years. These decisions had winners and losers. The data shows clearly who won. In 1975, one income could buy a house and change a family's life, build equity, create security, establish a foundation for generational wealth. This was the promise of the American middle class. In 2026, 2 incomes can't afford that same opportunity. Not because people aren't working hard enough, not because of individual failures, but because the economic system was fundamentally restructured. We want to hear from you. If you lived through the 1970s economy, how do these numbers compare to your experience? If you're trying to buy a house today, how does this analysis match your reality? Leave a comment below. If this video helped you understand what changed in the American economy, please subscribe to this channel. We're creating more content that examines economic history with data and context. No politics, just facts. Hit that subscribe button and share this video with someone who needs to understand what really happened to the American dream. The system changed. The data proves it. Understanding why is the first step toward anything changing again.